All right, so it's time to formally introduce the Greeks to you. So the Greeks are all the things that affects an option's premium or price. So again, when we are buying an option, we want to ensure that the price of the option goes up. When we're selling an option, we want the price to go down. But what affects the price? And basically, there are 5 things that affect the price. Number 1 is delta. Number 2 is gamma. Number 3 is vega. Number 4 is theta. And the last one is rho. We won't be looking too much at rho because rho measures the change in the option price due to a 1% change in the interest rate. And that normally affects only very long-term options that we are not going to really be focusing on. So no worries about rho, we'll be focusing more on the first 4, delta, gamma, vega, and theta. So let's go to the first one, which is theta. So when you think of theta, think of T, which is time. So we'll be talking about time value and expiration. Now again, when we buy options, we can buy options with different times to expiration. It's really up to us. And of course, the longer the time to expiration, the more time value, the more expensive the option is. So again, you can buy options with time to expiration as long as 3 years, as short as 1 day. As I mentioned, the further the expiration date, the more time value, the higher the premium that you pay. What happens is once the option reaches the expiration date, there's no more time value. Time value becomes 0, and the option price is equal to the intrinsic value. So if the option is in the money, there's an intrinsic value. If the option is at the money or out of the money, there's no intrinsic value and the option is completely worthless. So look at this chart over here, and you can see that as time goes by, the option loses time value. So it's known as a decaying or wasting asset. It loses time value till eventually the time value goes to 0. And time value tends to decay the fastest in the last 30 days. It declines exponentially. So as traders of options, we want to sell our options, right, 30 days before expiration. So in other words, we buy an option and we want to sell it at a higher price. So in general, we always like to sell it when there's still some time value left, when there's 30 days to expiration, because 30 days to expiration, the time value tends to decrease exponentially. And if we hold on to the option, what's happening is that we're losing a lot of value in the option. So we want to, again, sell it as high price as possible. So we're going to sell it before we lose that time value. But there are exceptions to the rule. If the option is really deeply in the money and we want to hold it a bit more to expiration, there's nothing wrong with that as well. But if we're not really deeply in the money, then it may be a good idea to sell 30 days before expiration. Now, when do options expire? Most of the time, we trade monthly options. Now, there are also weekly options, but for most part, again, we trade monthly options and they always expire on the 3rd Friday of the month. So again, recall when you look at the option chain, which you saw a while ago, there was a column called theta. So theta is the rate of decay of an option. So when you see a theta of minus 0.05, that means 5 cents loss a day, which means every day that passes, the option loses 5 cents, including weekends as well. And again, as the option nears the expiry date, you could go up from 5 cents to 6 cents to 7 cents. It increases as you near expiration till the whole thing goes to 0. So again, all options have fixed expiration dates. There are weekly options, but they tend to be less liquid with less transactional volume. They tend to expire on the Friday of every week. Like I mentioned, we tend to prefer to trade monthly options with more liquidity, with more volume, and they expire on the 3rd Friday of the month. So when options are more liquid, when there's more transaction, the bid-ask spread tends to be tighter. So we can buy and sell without that much slippage in the markets, right? Now, there are also quarterly options that expire every quarter, and these quarterly options expire on the last day of the quarterly month, like January, March, June, and September. And finally, you have LEAP options. LEAP stands for long-term anticipation securities. And leap options are options that expire many years in the future, for example, 3 years in the future, and they tend to expire on the third Friday of January. So that's what you need to know about time value and theta. Now, as an options trader, the next thing that we really have to pay attention to is the volatility of the stock and the market, because volatility makes up a huge part of the extrinsic value of an option. And many amateurs, they fail to look at volatility, and so they find themselves not profiting as well. So as professionals, we focus very much on volatility before we buy or sell an option. Now, in general, the higher the volatility of a stock, the more expensive the options are. So when does volatility increase? So there are times when volatility is really low and there are times when it's really high. It tends to get high during news events. For example, when a stock is going to announce earnings, its volatility increases tremendously. Or when there's some kind of news event like the FOMC, which is the time when they announce interest rate increases or reductions. So times like that, volatility increases. If you're trading oil, whenever there's an OPEC meeting, volatility increases as well. So always remember the golden rule. We only buy options when volatility is low. Because when volatility is low, option prices are low. And you always want to buy when they're low, when they're cheap, right? You want to buy low and sell high. Okay? And you only want to sell options when volatility is high. Because again, when volatility is high, options become expensive. Premiums are high. That's when you want to sell, because you want to sell high and eventually buy back low. Now, in the basics option course, we're going to focus more on buying options. In the advanced course, we focusing more on option selling strategies. So for the purpose of the basic course, we want volatility to be low before buying call options or put options. Got it? All right. So question people ask would be, how do you measure volatility of the stock or of the market, or of oil prices, or of the euro, for example? Well, we look at a very important measure known as implied volatility, known as IV. So from now on in this course, when we mention that IV is high, it means high volatility. IV is low, low volatility. So again, when do we buy options? When IV is low. Very good. When IV is high, never buy options because you can't make money. Similarly, when IV is high, you want to sell options. So first of all, what does IV mean? What is implied volatility? Well, implied volatility shows us where the market views the volatility of the stock in the future. And option prices always price in future expectations. Okay? Implied volatility basically implies the magnitude of the underlying stock price move within a year with a 1 standard deviation probability. What the heck does that mean? Okay, let me break it down for you. All right. So basically, let's imagine there's a stock which is selling at $50. For example, again, Coca-Cola, and the stock has an implied volatility of 20%. So what does it mean by an implied volatility of 20%? Well, it means that the market expects the stock to move up by 20% or move down by 20% within a year, within a 68% probability. And that's what it means by 1 standard deviation. 1 standard deviation means a 68% probability of it happening. All right. And so how is this 20% measured? Well, it's measured using an options pricing model known as the Black-Scholes formula. So don't worry about all that. Let's leave that to the mathematicians. All we care about is what's the IV right now. So how can you find the IV? Again, when you go to your Thinkorswim platform or whatever platform you're using, you can check the IV. So for example, under option statistics, you can see for this stock, the current implied volatility is 32%. Okay, so is that high or low? Well, we have to measure it based on the stock's 1 year history to say, okay, based on its 1 year history, what's the rank? Is it, high or low? So what we are more interested in is to look at the implied volatility percentile. So this is what we are looking for. And it's shown in terms of a percentage. So in this case, it's 46%. So in general, we want to buy options only when the IV percentile is below 40%. That tells us that options are cheap right now. And we want to sell options ideally when the current IV percentile is above 50%. But again, we'll focus more on that in the advanced options course. Are we okay so far? All right. If you have to review this video, do it as many times as you can before you get it. But again, for now, remember, we're just interested really in the current IV percentile. For it to be below 40% to buy options ideally. Now, let me introduce you to the next Greek. So we've learned about theta. The next Greek has to do with volatility. It's known as Vega. So Vega is V. V is for volatility. So Vega measures how much the option premium will change due to a 1% move in the implied volatility. So how sensitive is the option to implied volatility? So let's imagine there's an option with a premium of 150, selling at 150 premium, and its Vega, it's 10 cents. So what does it mean? It means for every 1% move, if implied volatility moves from 20% to 21%, which is a 1% move, the option premium will increase by 10 cents from 150 to 160. Now, in general, the further we are from expiration, the higher the Vega. So when you buy options with long expiration dates, you've got higher Vega. Shorter expiration dates, you've got lower Vega. The next thing is delta. So delta is really important because delta measures the change in the option price or premium relative to the change in the underlying stock price. So again, delta tells us for every $1 move in the stock price, how much does my option price move? So if you see a delta of 0.8, what does it mean? It means that for every $1 increase in the stock price, the option price will increase by, there you go, 80 cents. Okay, now this is also known as 80 deltas. Okay, so notice that for calls, delta is always positive. Why? Because when stock price goes up, calls go up. So it's in the same direction, it's positive. But for puts, delta is always negative because put prices go opposite of the stock price. Stock price goes up by $1, puts go down by a certain amount. All right. So in general, notice that whenever a call option is at the money, the delta is always 0.5, always, or 50 deltas. Which means when you buy an option at the money, if the stock price goes up by $1, your call option will go up by 50 cents, half. Okay. And options that are out of the money will have deltas of less than 0.5. So for every $1 increase in the share price, deltas, the option price will move less than 50 cents. And in the money, call options have a delta of between 0.5 to a maximum of 1 delta. So when the call option is very deep in the money, deltas increase to a maximum of 1. So 1 means the option behaves like the stock. The stock goes up by $1, the option call will go up by $1. So the same thing for puts, right? So at the money puts, delta is always minus 0.5. Out of the money puts, delta is always less than minus 0.5. In the money puts, delta is always anywhere from 0.5 to 1 negative. So if the put has a delta of minus 1, all right, by the way, in reality, you never have a delta of 1 or minus 1. It's 0.99 or minus 0.99, right? So again, if you see a delta of minus 0.99 in a put option, it means that for every $1 decrease in the stock price, the put option will increase by 99 cents, which is again almost 1 for 1. The other interesting thing to note is that delta also tells us the probability that the option will expire in the money at expiration. So in other words, when you see a delta of 0.5, it also means that there's a 50% chance the option will expire in the money at expiration. And again, if it's 0.6 in the money, it means 60% chance the option will expire in the money at expiration. So a common question people ask would be, okay, so what's the best strike price to choose? What's the best delta to go for? Now, there's no holy grail answer. It really depends on your strategy. Some traders who are more aggressive, they prefer to buy options that are at the money or one strike out of the money. Now, when you buy options that are out of the money, they are cheaper. So that's a good thing about it. But there's a lower probability that it will expire in the money. Your chances of winning are lower. So you have to be confident in a very strong move in a stock price to buy options that are at the money or out of the money. Traders who are a bit more conservative would buy options which are deeper in the money. When it's deeper in the money, your delta is higher. So when the stock price moves, your option moves faster. And there's a higher probability that you expire in the money. So that's the good thing about buying in the money. But they tend to be a bit more expensive. So again, there are pros and cons, and we'll look more into that into detail under the strategy section. Alrighty, let's look at the last Greek, which is gamma. So remember that as the stock or the option gets more in the money, the delta is higher. As the stock price moves, the delta changes as well. So how much does the delta change? Well, this is measured by gamma. So gamma measures the change in delta due to a $1 move in the underlying stock price. So gamma is known as the delta of delta, right? So if you think of delta like speed or velocity, gamma is kind of like acceleration. How fast does delta move with the stock price moving by $1? Okay, so we like to have high deltas and high gammas. And gamma is the highest when the option is at the money, as you can see from the chart, and tends to decrease as it goes out of the money or in the money. And gamma tends to increase the closer we get to expiration date. So as the option is expiring, theta is decaying, so not really good as an option buyer. But what's good is that gamma increases as well. That will increase the delta as the price moves in our favor. All right. So basically, that's how we read the Greeks. Now, another column you may notice in the option chain is known as open interest. So what does it mean? Well, open interest tells us the total number of option contracts that are currently open and have not been closed yet. So they're currently active. So these are contracts that have been traded but not have yet been closed, exercised, or assigned. And open interest does not change throughout the day. It only adjusts itself at the end of the day for the next trading day. So how do you read open interest? Well, now remember that if you want to buy an option, like you want to buy a call or put, you have to first buy to open and you sell to close it, right? So you buy low, sell high, hopefully, and you make money. Or you can also make money by selling first. So you sell to open and then you buy to close. So again, if you're selling, you ideally want to sell at a high price, sell to open at a high price, and buy to close at a lower price. So in both circumstances, you're opening a trade and closing a trade, right? So whenever you buy to open, or whenever someone in the market buys to open, it creates a +1 in open interest. So open interest is +1. That means one contract has been opened. And if you sell to close the contract, or someone sells to close your contract, it's -1. So open interest becomes 0. Similarly, if you sell to open a call or put option, open interest becomes +1. And if you later buy to close the option, or someone buys to close it for you, it becomes a -1. So it keeps changing all the time. And over here, you can see the total open interest for each of the different options at the different strike prices. So why is this important to us? Well, basically, we like to trade options with a lot of open interest. The more open interest there are means the more active that option is. And the more active it is, notice the bid and ask, the spread between the bid and ask tends to be tighter. When you see an option with the bid and ask very far away, those are not good ones to trade. You want the ones where the bid and ask are close together. All right. And again, as we go into the strategy section, you'll be seeing that we normally trade options with very tight bid and ask spreads with relatively high open interest. If you see options with zero open interest, that means there's no one trading it. Don't trade those options. Got it? All right. All right. So again, if you take a look at the Thinkorswim charting platform, if I were to key in a stock, like again, if I could key in whatever Citigroup. So you could see that again, we have got our option chain. And if I click on this, you can see today's option statistics. So this is what I'm interested in over here. And you can see that for Citigroup, what is the implied volatility? It is 38.92%. But like I said, the most important thing is to look at the current IV percentile, which is, my God, is 100%, right? So what did I say? I said that we only want to buy options when the current IV percentile is ideally below 40%. So this is way too high to buy options on Citigroup. And if you buy options on Citigroup, they are really expensive. The premium is really, really high and it's really hard to make money. And one reason is because recently there's been a big plunge in the S&P 500 index, creating a lot of uncertainty and fear, and kind of like hurricane season, high volatility, so the IV percentile is really high. But again, if your strategy is to sell options and collect premium, then it may be a good time to sell covered calls, for example, with a high IV percentile. Now over here, you can see also on the option chain, you can select the layout where you look at delta, gamma, theta, and vega, or you can also look at the open interest over here. Right, so that's the open interest, and you'll be learning about that as well. Right, you can see that there are certain options with zero open interest, which means that no one is trading those options. So you do not want to buy options with the strike price with no open interest as well.